Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Yes, welcome to your U.S. market update. The S&P 500 reached fresh highs yet again on Wednesday after a reading on wholesale prices unexpectedly declined, a welcome development for investors clamoring for a Fed rate cut next week to boost the economy. The broad market index finished up 0.3% at 6,532, a record close for the index. It had risen about 0.7% at its peak to 6,556, scoring a new all-time intraday high as well in the process. The Nasdaq Composite, meanwhile, edged up marginally 0.03% to end at 21,886, likewise notching a closing high after hitting an all-time intraday high prior to its afternoon pullback. The blue chip Dow, meanwhile, lost 220 points or 0.5% to finish at 45,491, bogged down by a decline in Apple shares as the latest iPhone announcement failed to impress investors. By the end of the session, most of the up move was gone, with Oracle and AI-linked stocks notching the biggest gains. There were more losers in the S&P 500 than winners. To deconstruct all of that, we have now with us José Torres, senior economist at Interactive Brokers. José, how are you? Welcome back to the show.
Good morning. Great to be here. Appreciate you.
Yeah, thanks for coming on. Now, what's happening in markets? They're scaling new highs every day, it seems, despite the fact that September is historically a weak month for markets.
That is absolutely the case. But you don't want to know something? When the Fed is cutting in September, it actually is a bullish month.
Yeah.
You know, we actually had a bullish September last year as well in 2024. And before those years, we had a pretty bad stretch on this back to school month. Yesterday, we got the benchmark payroll revisions that were down 911,000, which really essentially cut job growth in half in the 12 months up to March. And a big driver there, Emaad, was the fact that those revisions don't account for the immigration tailwinds that the original numbers have because they're reconciled with state unemployment claims that undocumented migrants cannot file. However, a lot of them work 2 or 3 jobs, because they're looking to maintain families, they're looking to save money, et cetera. So that's the reason for the big revision there, a big reason. And then we got the PPI number a lot lighter than expected, 0.1% month over month decline. The year over year figure came down to the mid 2s, which was great because it was up at 3.3%. That also got revised down to 3.1%. Now, we have a CPI report in a few hours. And if you have a trio of developments, so payrolls went the monetary policy doves' way, PPI went the doves' way as well. Now, if you have a lighter than expected CPI, which, by the way, I'm expecting, then I'm projecting that the odds for a 50 basis point reduction will go up from roughly 10%, which is our prediction market is forecasting right now, to up to 30 or 40%. So if we get a lighter than expected CPI, annualized reading a 2.7 or 2.8%, I think that'll be enough to get a 50 basis point reduction from the Fed. And that's why stocks are so buoyant. One of the reasons why they're so buoyant is this faster expected walk down the monetary policy stairs. Investors are thinking 75 basis points of cuts this year from the Fed, more next year. That brings a 2-year yield to roughly 3.25, 3% in a few quarters. And the 10-year yield looking like it's going to go below 4% as well.
We'll come to CPI and PPI data in a little bit, but one of the companies that is leading that buoyancy in the markets, at least yesterday, was Oracle. Rather, perhaps unsurprisingly, their stock roared 36% higher after reporting some gobsmacking cloud demand numbers, setting the company to a historic gain. In fact, they posted an all-time high and had its best day since 1992, gaining $244 billion in market cap, which now stands at $922 billion all told. And they have been one of the biggest benefactors of the AI boom, thanks to that cloud infrastructure business. Was that surprising to you as well?
It was an absolute shocker, Emaad. I'm the economist. So, I look at single names a little bit further than your traditional equity analyst, but nonetheless, it was a huge number. And you know what was so surprising? The results for the actual quarter were pretty in line with expectations. What really, really brought out the bulls was the outlook for the future. And it looks like artificial intelligence investments, capital expenditures are going to continue. The momentum there is strong. The outlook was outstanding, the guidance, that is. And for that reason, folks are thinking that, wow, they were doubting for a few weeks because this artificial intelligence themes, it goes through cycles. Oh, it's too much. Oh, now we're getting too bearish. Today is one of those days where folks are saying, wow, we have a lot more to run. And let's remember, this bull market has been fueled by artificial intelligence and AI. So to the extent that a lot of these S&P 500 constituents come out here and talk so well about artificial intelligence and give such a buoyant outlook, then that tells Wall Street that this run has a lot further to go. And it's not just Fed cuts, it's not just artificial intelligence. So many other things are going in the bulls' favor on Wall Street these days.
Yeah, Jose, how soon do you expect the AI boom to spread out beyond the S&P 500 and the Mag 7?
That's really a big question mark. I think it's going to take roughly 3 to 4 years. Medium-sized and small-sized companies, they're still figuring out how to use it, where to allocate it. They're still trying to figure out if this is really going to be cheaper than labor in a lot of different businesses and how to repurpose labor in some instances. So it's really a big question mark in terms of the adoption. We know that CapEx has been terrific, but as far as how it's going to drive profitability across the entire corporate America, I'm bullish. But it's still a question mark in terms of, can those companies in the Russell 2000, can those traditional mom and pop, smaller kind of businesses, can they really benefit from this advanced technology?
Yeah, let's come back to PPI data now. There was speculation ahead of that release that companies would either have to make a decision between lowering their margins or passing on higher costs to consumers. I guess that's been put on hold for the time being.
Core goods as a percentage of the U.S. economy and as a percentage of inflation is really limited. It's only 20% of the inflation picture. When you look at core goods and then you see things like used cars, new cars, and then capital-intensive products like your durable goods that people rely on financing for, high interest rates have also curbed the pricing power a lot of these firms have. So you have a mix of two things going on. You have that core goods, physical products, excluding food and energy, that is, don't comprise that much of the U.S. economy, one. Two, you have high interest rates really curbing those price gains for a lot of those more expensive products like automobiles, furniture, and appliances. So that's really, it hasn't really been a factor. And that's another reason why Wall Street is cheering. Really twofold, because it hasn't driven up inflation, but it's also the tariff revenues have been quite buoyant, and that's helped long-term borrowing costs be more subdued. And we see that there's duration problems, so long-term bond yields rising significantly. In Japan, in the UK, we see these rising bond yields, and there's there's a lot of momentum to that increase. Here in the States, we're seeing long-term bond yields really begin to come down. There are worries about the labor market health, but another thing helping contain those borrowing costs is the fact that the fiscal situation is getting help from an unexpected assister, which has been those tariff revenues, roughly $30 billion or so per month, and there's some estimates out there that point that they could go a lot higher.
They could go a lot higher in the months to come. I want to turn to the CPI report that is scheduled to come out later tonight, Singapore time, tomorrow, U.S. time. If that does come in lighter than expected, and as you said, leads to a potential jumbo cut at the next FOMC meeting of 50 basis points, do you still expect 2 additional cuts, as other economists do, for the remainder of the year?
Yes, assuming that the inflation landscape remains tempered. As long as inflation is in the mid-twos, call it 2.3 to 2.8%, then yes, we can get 100 basis points of cuts this year. But of course, there's risk to that outlook, because as soon as you cut by 50, what happens is similar to what happened last year. Why they cut last year? Because the labor market started slowing below that 100,000 mark, and then they wanted to cut. As soon as they cut 50, Emaad, the hiring rates immediately shot up, especially in a lot of the rate-sensitive areas, small businesses, construction, manufacturing, et cetera. So there's a risk that which is a positive risk for equities, by the way. There's a positive risk that the Fed cuts 50, hiring goes through the roof, they cut again in October, and then in December they decide, hey, let's pause, because now the economy looks like inflation is becoming more of the upside risk. Now that it looks like the labor market is back. We're back above 75,000 on job gains, theoretically, and the unemployment rate is down to 4.2 or 4.1%. So, I could see that scenario occurring.
So against the backdrop of what's transpiring in the markets right now, what's the investor playbook?
I think the investor playbook is to remain bullish, choose the leaders, maybe add to some areas that are underappreciated. Bond yields, I don't like treasuries anymore. I liked treasuries when the 10-year was up closer to 5%. Here it looks like we're approaching fair value. But the thing with equities and the animal spirits is when the market starts to run, it starts to really feed on itself, and it starts to run further and further. And when you look at the political backdrop, you have milder regulations, lighter taxation, subdued energy costs, a very pro-business climate domestically. It's hard to not want to be in U.S. stocks, especially when you look at the earnings expectations. 2027 earnings are expected to grow faster than 2026. So you want to be in U.S. stocks despite those elevated valuations. If you're worried about valuations, sell some calls, buy some downside insurance, buy some downside puts, strategically when you feel like things are getting too frothy, or be in more value areas of the market. But recognize that those areas have underperforming for ages.
All right, Jose, thank you so much for your time. As always, it's been a pleasure chatting with you.
Thank you so much. Looking forward to next time.
Yeah, likewise. That was José Torres, Senior Economist at Interactive Brokers, and you are listening to Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.